Hello everyone, this is Fair Value Finder. Welcome back to the channel. Today we are taking a look at BTI, British American Tobacco. There was a request to take a look at this one. I've seen it come across in the past, stuff that I've looked at. It's interesting because it's not an American company, it's a British company. And so they do things differently. They don't have quarterly earnings. They have half year and annual meetings where they talk about the progress of the company, and there are no analysts. So all that I'm able to use for earnings per share is the trailing 12-month number. But we can still take a look at it and see what's going on here, because it looks a little interesting. So revenue, kind of low, a bit lower than we would want. I mean, we want something at least 5. The cost of goods is good, though. So they've been able to drive down those expenses. Their expense ratio, very good. I mean, they seem to have decent margins. Their gross profit's 83% as of this last year, net profit of 24%. So those are healthy, good margins. And then we continue on. Their expenses in total have declined year over year. Interest expense specifically, they seem to be doing really good at driving down their debt, or at least their interest expenses. And we see that 11.8% drop year over year in that expense as a portion of revenue. I mean, last year was pretty low. They just had a higher revenue year off lower expenses. Maybe they can continue that, but typically they're in the 60s. We continue on. There's nothing major in any of the non-highlighted numbers. The ROE on this company is very low, 8.8. We want at least a 20 before we even start talking about holding it for something long-term. And especially for such a high margin, that's a pretty bad ROE. They have been able to drive earnings per share, though. We see some nice consistent growth, a pretty big jump this last year. I have no idea what this year is going to be. I can't find any guidance from them. They haven't put out Q1 earnings because they don't do that, and there are 0 analysts. So it's really hard to value this stock based on that. We can just look at how it did last year and maybe factor in how it typically grows. We see that as for a PE, it trades in the low teens. It looks like on average 13.86 over the last 4 years. So we'd be looking at about a $50 per share value by that metric. And going forward, it might be a bit better than that, but around the same. Balance sheet, we see they are growing their assets. Their net tangible assets declined a bit. I mean, anything less than 0.5%, we kind of say is flat. So it looks like their total liabilities have basically stayed flat. Pretty good growth in the common stock equity. Tangible book value, this is a very large negative number that has continued to grow negative. I mean, 2019 was the lowest number that we see here, but they had worked it down in 2020, and it's kind of jumped back up since then. The total debt, they have been decreasing their debt, which helps with that interest that we saw up above, and they've been buying back shares very slowly. It looks like they essentially didn't buy any shares back up until this last year, where they bought back 2.6%. So if they're starting that trend, that would be nice, but we'll have to see if they continue with that. Cash flows, they're good at driving that operating cash flow. That's near what we'd like to see. I just rounded it up. We see cash per share. They've been growing the amount of cash that they have on hand per share pretty well. And their free cash flow, they've been growing really well too. So this is a really strong free cash flow stock, which is probably why it's such a strong dividend stock. When we see them paying 6.7% on average for their dividend yield. Right now it's at 6.2. So on that metric, it's a little undervalued. But they're all over the place on the dividend that they pay. So as of what they've been paying recently, it puts the fair value of this stock at $37.68, which is right about where it's trading. A little bit lower. It's about $32 today. And then going forward, over time, this dividend's kind of been decreasing. So we'd be looking at a bit of a decline there. So all in all, this is such a hard one to do. That balance sheet is really bad. So I wouldn't touch it for that reason, and the inconsistent dividends, just reasons that I wouldn't touch it. If it's something that you own or something that you're interested in, the earnings are good and the dividend is all right if they can hold it, become more consistent with it. It looks like somewhere between $40 and $50 is a decent price for the stock, which makes the $32 that it's at right now kind of a deal. It'd be approaching value prices, but it doesn't meet ROE. It doesn't meet on revenue growth. It doesn't meet on a tangible book value, and an inconsistent dividend. I mean, every single thing that we look for, it fails on. So I wouldn't buy it. I wouldn't necessarily rate it a sell. Probably a hold, potentially a hold. Since I can't pull up any earnings for us to look at, all that we can do is look at the chart here. So for the chart, we see that $50. I mean, it had gone up above that $50 back in 2012, was staying up above it for quite some time, and then around 2018, it dipped below. So it's another one kind of like Altria, where you're going to have a lot of legal issues and just a lot of pressure on the stock that has nothing to do with how the company actually runs. It's just the social aspects of the company. Like, we see it just following this decline that it started back in 2017. It's kind of been on the decline. And Altria is kind of the same way. Of course, holding this would be a riskier play. It could have some upside, but it's definitely not something that I'm looking for my portfolio. So hopefully you guys enjoyed this one. It helped get you some information that you were looking for. Please like if it did. Comment, let me know what other stocks you'd like to see. Subscribe if you want to see even more, and I will catch you next time.